Technical charts and Germany's recent move off of their hardline stance tell us to continue to be open to better than expected outcomes in stocks. We continue to see technical setups and intermarket relationships that look similar to the early stages of melt-up periods in 2009, 2010, and 2011. We'll look at several markets and make the comment the last time this happened, stocks went up. We'll look at several markets that have a potentially bullish setup in the form of an inverted head and shoulders pattern. We'll take a look at these markets here. They all have ADX setups that tell us they may be in the early stages of strong bullish trends. This is a weekly chart of the S&P 500 index. We're looking at trend lines from October of 2007. Here in early 2011, resistance, bullish breakout here, late 2011, early 2012. This bullish breakout is confirmed here. What once was resistance acted as support. This line here was an area of resistance. Another bullish break recently in 2012. If you'd like to watch this video in full screen mode, you can click in the lower right hand corner of your video player. This is a monthly chart of XLU utilities relative to the S&P 500 index. You can think of it of the ratio of defensive stocks relative to growth stocks. When the ratio here is rising, defensive or risk off is in vogue. When the ratio is falling, growth or risk on is in vogue. You can see here a series of lower highs tells us that the desire to be in defensive issues has been waning a little bit. In our minds, this tells you that the concerns about Europe imploding are also waning a little bit between late 2011 and early 2012. What's this chart telling us? Here we've got the ratio breaking through the exponential moving average. It's the 9-month EMA, which is this blue line here. We get a bearish break with the moving average rolling over in a bearish manner. After that period, this is the S&P 500 monthly, after that happened, stocks went up. Bearish break ratio underneath the blue line moving average rolling over, stocks went up. Bearish break here, late 2011, early 2012, with the moving average in blue rolling over, stocks went up. Present day, break, bearish, moving average rolling over. This period here looks similar to this period here, here, and this period here. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the NYSE Composite Index. 50-week moving average in blue here. This is the 200-week moving average here. The comments we made previously were red moving average turns up when the blue has already turned up. Stocks did extremely well. Blue rolls over in a bearish manner. Red rolls over in a bearish manner. Stocks did very poorly. Bullish here, stocks did okay. This period here, the blue arrows, and we did get last week a close with the red turning up and the blue turning up. The last time this happened was this period here, and the NYSE Composite gained 45% from this point here to this point here. This is a long-term weekly chart of the S&P 500, another chart that we have reviewed extensively in the past. It goes all the way back to 2009. These are parallel, upward sloping, bullish trend lines. The point is, when the market was here, it began to rise. It made it from this blue trend line to this line here. From this blue trend line, again to this line here. We held here in a similar manner to this point and this point. If the pattern continues, we would try to fill this white space and move to this upper trend line here, as we did here and here in the past. This is a weekly chart of the S&P 500 index. This looks complex and noisy. It's very, very easy to understand. This is the weekly S&P 500 here. This is the relative strength index our RSI here. Point of the exercise. In 2010, when the stock market was struggling in this orange box, weekly RSI here stayed below this green line, which is at the 56 level. Once weekly RSI broke out above 56 here, the stock market did well inside the green box. Similar situation in late 2011. The markets are volatile and somewhat unsettled when weekly RSI stays below the green line or the 56 level. When weekly RSI broke out above the green line and above 56 here, the stock market did well for several weeks. In the present day, we have a similar breakout here into the bullish territory. Weekly RSI is above 56. The present day looks similar to this period here and this period here, where stocks advanced for several weeks. This is a weekly risk-on versus risk-off chart that we explained in detail on our blog this week. Short takes. This is the ratio of stocks, or the S&P 500, to long-term treasuries. When the ratio is rising, risk is on. When the ratio is falling, defensive measures like treasuries are more popular and more in demand than stocks are. This chart looks intimidating. It's very easy to understand. Here's the ratio. Below it, as a reference point, we have a weekly chart of the S&P 500. We're looking for two things here. We're looking for the lower Bollinger Band to turn up, as it did here in 2010, and we're looking for the ratio to cross this dotted center line as it did here. Once 1 and 2 took place, the stock market gained here for quite some time. Going backwards to 2009, we've got the turn up here that looks similar to this period here. The ratio crossed the center line here, and gains followed in the stock market. Same situation in late 2011, early 2012. Blue turns up, ratio crosses the center line, the stock market does well. We have a similar signal here, blue turning up. Last week we closed above the center line. The present day is similar to this period here, and this period here, where stocks advanced. This is another ratio chart that looks complex, very, very easy to understand. Here we have the S&P 500 daily. This is the ratio here of technology, QQQ, ETF to SPY, so technology relative to the general stock market. When the ratio is falling, technology is out of favor. When the ratio is rising, technology, stocks like Apple, are in favor relative to the S&P 500. Late 2011, early 2012. The ratio is falling, making a lower low, but MACD histogram has a bullish divergence, foreshadowing this breakout here. Once technology broke out above this downward sloping trend line here, the S&P 500 did well. We have a similar bullish signal in August of 2012. Here is your bullish divergence here, ratio making a lower low, higher low here, similar to this period here. We recently had a breakout here that's similar to this period here. The present day is similar to early 2012 when the S&P 500 advanced for several weeks. On all these charts, we will remain bullish as long as the signals that we're showing remain in place. Obviously, these charts can reverse and the signals can be erased or negated, but as long as they're here, we'll pay attention to them. This is the equal weight S&P 500 ETF RSP. It's a weekly chart. The blue line here is the 50-week moving average. We've shown this in the past. Mainly wanted to say that the bullish signals that we were looking for remained in place at the end of last week. When the 50-day moving average, the slope of it turns up, stocks tend to do well. When the slope rolls over here in a negative manner, stocks did poorly. Bullish turn in the blue line, stocks did well. Bearish turn in the blue line, stocks did poorly. Bullish turn in the moving average here, stocks did well. Point of the exercise, getting what appears to be a bullish turn up here, which looks similar to this point here, and this point here, where gains in the stock market followed. Now we're shifting gears to what can be bullish chart patterns in the form of inverted head and shoulders. We're looking at the daily chart of German stocks, or EWG, the ETF. Here's your left shoulder. This is the head here. This is the right shoulder. As we've mentioned in the past, when the right shoulder is smaller than the left shoulder, that tends to be bullish. This is your neckline here, the blue line at the bullish break here. This line here is your probabilistic target, which tells us that EWG could still post gains up to this area here to complete the pattern. We also circled this previously. We were concerned that RSI was unable to break out. As you can see here, it has broken out above this line. Still doesn't look great, but all things being equal, we'd prefer to see it here rather than down here. If you follow the markets closely, you know that both Spain and Italy have been problem areas, so if we have a potentially bullish inverted head and shoulders chart pattern on Spain, that would tend to be good for all risk assets. Doesn't look too clean on this chart, but this could be a giant left shoulder here. This is your head here. Notice the head is lower than the left shoulder. This isn't too clean on this chart. I'll show you on the next chart it's a little bit cleaner. This is a very small right shoulder, and this would be your neckline with a bullish break. If this is a head and shoulders pattern, EWP could post impressive gains if this breakout here holds. This is the same chart. Now we're using high-low close prices with bars. It's a little bit easier to see the neckline here. Big left shoulder. Here's your head and a very small right shoulder. If the probabilistic target were hit from this point here, EWP or Spain could gain roughly 27% from a probability perspective. Similar concepts here. EWI, this is Italy on a daily chart. This could be a big left shoulder. Here's your head here coming up to the neckline, and a very small right shoulder, and a potentially bullish break here last week above this neckline here. Similar situation on VEU, the All-World Global Stock Index, sans the United States. This is an inverted head and shoulders that we looked at previously. Here was our target. This purple target was hit here. Similar situation here with a bullish breakout and a potential probabilistic target that literally goes off the chart. Now we're looking at a daily chart of the S&P 500. Again, this looks complex, very easy to understand. This is the stock market here. This is an indicator known as ADX that helps us identify the direction and strength of present trends. The black line here shows you the strength of a trend. These are your directional lines here, the green and the red. A bullish signal occurs when you have a sleepy trend. When the black line is at low levels, that's a sleepy market. When the black line turns up below both of the directional lines and moves up 4 notches from a low, that's an indication of a potentially strong trend. To figure out which way the signal goes, when green is over red, when this happens, that's a bullish signal. Gains followed in the stock market. It works both ways, turning up from a low level here, but in this case, red is above green. This is a bearish signal, and weakness followed in the stock market. In the present day, the black line started somewhere in the neighborhood of 1256. We've moved up to 1737 as of Friday's close on August 17th, which is more than 4 points below both lines. This is a potentially very strong bullish signal. We get the turn from a low level, 4 points below the directional lines. We know this is potentially a bullish signal because green is over red, which is similar to this period here where gains followed in the S&P 500 index. Now we'll quickly scroll through several markets that have a very similar bullish ADX setup that we just discussed on the previous slide. At any time, if you want to pause your video player and study ADX relative to the market, you can. This period right here looks similar to this period here, where gains followed in tech stocks. Similar setup with ADX here on the daily chart of the Dow Jones Industrial Average. We have a very, very sleepy black ADX line here. ADX can give you head fakes, so what we want to see is this line to turn up, and we want the green line to remain above the red line, which would be similar to this period here. Small caps have been laggards in recent weeks during this rally. We'll be watching this closely. This is IWM, the Russell 2000 small cap ETF. ADX setup here, similar to this period here, where gains followed. Obviously, when you see potentially bullish signals in numerous markets, it adds to the probability that they will turn out to be good signals. Same situation, bullish, potentially bullish setup in ADX on the mid-cap ETF MDY. Material stocks have also been laggards. We know central banks want to reinflate asset prices. Successful reinflation needs to have material stocks participating. We have a strong signal here on ADX. We also have a symmetrical triangle formation here. Resistance, resistance, bullish breakout, confirmed here. What once was resistance now may act as support. These ADX signals become strong signals when this black line moves up 4 points, which it has not done on the next 3 charts, which would be transportation is the first one. We do have a setup to potentially move. This is a sleepy market, green over red. If transportation stocks can continue to break out, this also looks like a symmetrical triangle, similar to what we saw on XLB. We'd like to see the transports break through this trend line here. The comments made on a previous slide about XLB materials apply to both gold and silver from a reinflation perspective. They've been laggards. They're showing some signs of life. This is somewhat of a symmetrical triangle. Like to see a breakout here. If the GLD ETF can get above this green line here, that would represent a trend change with the 3 steps. We have a sleepy ADX. Often strong trends start with a sleepy ADX. Need to see gold move into this area here, which would be good for reflation and risk assets in general. The ADX setup sleepy is in place for SLV2. We just need to see it move. Like to see it move above this line here. Now we'll move quickly through what I'll call breakout charts. This is TBT shorting treasury bonds relative to the stock market. Obviously, shorting treasuries relative to stocks has not been a good bet. When this is falling, it tells you that TBT is weak relative to the S&P 500. What we've noticed here is lower lows on the ratio. This is a bullish divergence here and here. This is RSI. Usually when you get trend breaks on RSI, you should respect them. Resistance, resistance, resistance. This looks like a bullish breakout for shorting treasuries relative to the S&P 500, which would be bearish for TLT and potentially bullish for TBT and risk assets in general. You hear some talk recently about the potential for a double or triple top in stocks. Those can happen, but they're rare occurrences. That's not really the way markets typically work. This chart throws a little bit of cold water on that potential bearish theory. Last week we made a new closing high on the weekly chart of the S&P 500. That's a bullish breakout on a weekly closing chart. Similar situation here. This is a monthly chart of the S&P 500. We're trying to break out in a bullish manner here, which would take away any double or triple top theories. We do have a potentially bearish form of resistance. This breakout here becomes meaningful if it holds into month end. Quick update here. If you've watched previous videos, you know we were concerned about this RSI resistance on the daily chart of the S&P 500. The good news is we did break above this line in a bullish manner last week with RSI closing at 68. Typically in a bear market, you don't see daily RSI get above 66, much less push all the way to 68. Saw some writings recently. This is NYSE stocks above their 200-day moving average. They said that this divergence here was bearish. Just wanted to make a note that this is a huge divergence here on NYA 200R. Stock market during this decline here, the S&P 500 has moved up roughly 400 points from 1066 to 1418, telling us that a divergence on this chart, while all things being equal, we would prefer that it not be there, may not be that important. This is a weekly chart of the Russell 2000 index, similar to IWM. Another symmetrical looking triangle. Last week we got a bullish breakout here. We also had a bullish breakout on the weekly RSI of the Russell 2000. As always, it's extremely important that we remain flexible and open-minded. The markets are over here in a bullish stance. The windsock can change. We have to be flexible and willing to change with the markets. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.